Hi friends, Simit here from InformedTrades.com. In this video, I want to take a look at Scott Ramsey, a very successful trader, hedge fund manager that was featured in Jack Schwager's book, Hedge Fund Wizards. The content in this video draws heavily from Schwager's interview with Ramsey in that book. That book, like Schwager's other Market Wizards book, is something that I thought was really great, very insightful, and I highly recommend it to those passionate about trading and looking to study other traders. Key points on Scott Ramsey and some of the things that have helped him succeed as a trader. He uses a combination of fundamental analysis and technical analysis. He uses fundamentals to identify the markets he wants to trade, the direction he wants to trade, which markets are worth and which assets are worth going long versus which are those shorting. And he uses technicals for timing trades to determine precisely when to enter those long positions and when to enter the short positions. Like many other traders, his name of his game is risk management. So when he enters a position, he is risking only 0.1% of the trade. Now, as it moves in his favor, he will, sort of follow the adage that many successful traders do of cutting their losses short and letting their profits run. So he will let positions fluctuate in their profit. But when that initial order is placed, that stop loss is going to be 0.1% from where he enters. He's risking very little initially on his trades. He likes to look at, or one of his favorite techniques is to, look at chart patterns that are, for instance, that are very bearish patterns, very, by common technical analysis will be bearish, but the fundamentals are bullish. When it's a textbook pattern that he thinks a lot of novice traders will gravitate to, while the fundamentals tell something opposite, he'll look to fade the pattern technically and look to side with the fundamentals. Ramsey's approach is very dependent upon market correlations. He'll use that also to identify which specific assets to go long, which to go short. Confluence is a big part of his strategy, looking for Fibonacci moving averages, RSI divergence, and like many other who are into fundamentals, intuition is a big part of his strategy. He believes intuition has developed over time as a trader gains experience. Fading popular patterns when the fundamentals disagree. Here's an example that sort of illustrates that concept in action. On the screen right now, you can see a descending triangle, very common pattern here. But this is a chart of gold, a weekly chart of gold. So if you believe in the gold story, which is, that so long as deficits and debt are continue to grow, gold will be a good opportunity. This is an interest where the fundamentals are potentially bullish, but you have a technical pattern that is a textbook pattern that's very bearish, and many traders gravitate to. So Ramsey will be looking to do the opposite pattern, fade this pattern. He'll be looking to trade a bullish setup, perhaps buying at this level rather than shorting, which is what many would do. That's an example of sort of fading the popular patterns when the fundamentals disagree. Another part of Ramsey's approach is market correlations. Specifically, what he'll do is look at which markets or which assets within a given sector are outperforming. Now, common wisdom, or what many novice traders may do, is to think that the laggards are worth buying, or the ones that have really rallied are worth shorting when the move is done. Ramsey's rationale is actually the opposite. So, for instance, if you're looking at QE1, for instance, we can clearly see the S&P equities, Russell 2000 clearly outperformed commodities, gold and copper. So when QE1 is done, and if a trader was looking to short the end of QE1, rather than shorting S&P or Russell 2000, Ramsey would actually look to short the commodities because they underperform. Look for confluence. On the screen right now is a sample where here's a Fibonacci line. Here's the 50%, 61.8% Fibonacci of this move down. Here we have the 200 moving average. We have a 50% Fibonacci line, and we have a doji pattern here, evening star pattern. This is the kind of confluence that Ramsey might look for. Right here, we have a bullish engulfing, and we have RSI divergence. Ramsey really likes RSI divergence in that price has made a new low, RSI is not. This coupled with the bullish engulfing pattern suggests the price may be ready to rally. Follow your intuition. Ramsey is big into intuition. He believes the subconscious develops it and something gained through experience. That's about it. If you have anything you want to share, join us at InformedTrades.com.